Hello and welcome to week number 28. We had quite an exciting week last week. There was a lot of moving things. Early in the week we had OPEC Plus coming out with some controversial comments that moved the oil market quite dramatically, and it also meant that it reverberated to all the other markets and kind of caused a little bit of havoc. And then moved forward halfway through the week, and then yields absolutely tanked just to do the incredible reversal around 125 point on the US 10-year yield. So there was a lot to digest last week, and I heard from a lot of traders that found it quite a complex week to trade. Some other traders were actually quite happy with the volatility. So a little bit of mixed messaging. Having a quick look and starting also this weekly analysis, having a look at the CFTC report. I'm looking at the Scotia Bank right now. Interesting thing that happened with the euro positioning, which is probably one of the most core ones you always want to look at when you look at the CFTC data, is that the euro longs position didn't really quite move. If anything, over the last 4 weeks, they've added to their positions from 210,000 and about shy of 213,000 position contracts long. But the problem that net moved is because obviously shorts added their positions as well, and they never abated. It's a continuous trend where shorts are adding to the positions, i.e. dollar longs are emerging more and more. The good thing is that creates open interest increase. That's what you like to see in a market. You like to see a bit punchy moves, volatility entering. Usually what happens around this time in summer, the volatility goes down, open interest goes down, and just moves aren't coming along. So it's quite a gift, given that open interest is moving a bit higher. Long position and short position, they're still wriggling out. I think the jury's still out where EURUSD wants to move and where fair value is for that. Same thing more or less on GBP/USD, where the open interest continuously rising, short's been adding, and long's been adding too, which is quite interesting to see. That was a quick round of the CFTC. Really what we gather out of that, the volatility is still there in this coming week. Looking at the calendar, I won't start off with that. I will start off explaining something interesting happened in the yield curve. When I say yield curve, I'm looking at the 10-year over the 2-year. Long story short, basically what this tells you is where the risk sentiment is on the long term and the longer time frames in the market. So as you can see, as we came out of the pandemic, they kind of went up. By the way, every time it goes zero, we tend to get a recession. So we had that before the pandemic happened, went to zero, and then it kind of started steepening quite aggressively. They gave us the reflation trades, they gave us the cross currencies with the yen, they all rallied quite aggressively, and all of that. Late March to middle May, when it really started all coming off, and the whole trade started to unwind, and all these things that came with it. Now, the way to construct this chart is the 10-year over the 2-year, and it's very important in terms of where market is headed. I'm going to put one of the major pairs over this so you just have a feel for how important this is for risk sentiment. This is GBP/USD in the orange and the yield curve in the candle, and you can already see that it's quite important for the market sentiment what the yield curve does. We're going to have a quick explanation on how to predict where the rest of the move will happen. So again, it's over 10 years, over 2 years. And have a look at the 2-year, because that's very predictable at this point of the cycle. We are in an environment where the 2-year is heavily regulated by the Fed. They won't let it escape the 25 basis point, because that is very interest rate sensitive, and they're not about to raise rates until earliest end of next year. So that cannot move for the time being out of this range. On the other hand, we have the US 10-year yield. And the US 10-year yield underwent 2 phases. The first phase was where people were long bonds and they were betting on yields to go higher. Sorry, they were short bonds. They were betting for the yields to go high. They got squeezed out. Something that we call in the industry as a short squeeze. You might have heard about it. So bond shorts, they got squeezed out. We had the first leg, and then Fed came out with their hawkish messaging, and that drove big inflows into bonds and just crushed yields further. That's how we all arrived at this point. Now the thinking is the bottom from the US 10-year yields could be right about here, 125 basis points. We might have another 1 or 2 steps lower, but general thinking is, and the fair value is, that this shouldn't go lower than that, and it can climb back up towards 140 basis points, possibly higher. Now, what does it mean for the yield curve? Of course, 2 years can't move anywhere, and if 10-year can move a little bit even higher, we're going to have a yield curve that's all of a sudden looking a little bit more constructive, but this whole rally has still got 1 or 2 puffs left into it. I'm expecting really this in the coming weeks for this to climb a little bit back up. That also means for cross currencies from the US dollar, like EURUSD, for instance. Let me bring up the chart here. For EURUSD, you can have another stab at about 190.50, possibly 120. Mind you, that's what I was looking for last week, but then the whole negativity with the yields and all of that kind of put a drag on it. But I'm expecting this still to move further up. 119.50 I feel is like fair value. 120 is definitely possible, more or less on GBP/USD as well, looking for a little bit of a higher move. But one of my higher conviction calls right now is USDJPY long and EURNZD short. I'm going to explain why. Starting with EURNZD, I think we discussed this last week as well. Throughout the week I kept trying to keep the idea alive that EURNZD should be really staying under this 170 handle. Every time I went above it, I felt like there was a time to sell it, and the signals went out, and the communications. The main reason is the ECB is not about to do anything about their interest rates, where the RBNZ is about to cut their rates. And let me show you the short term. So let me type this in. We got the Euro 2-year yields. Sorry, the German 2-year yields. Getting ahead of myself. Over the struggling to type this in, so try again. So 2-year yield on the German, take away from the Kiwi yield 2 years as well, and you get yourself a yield spread chart. The yield spread chart looks like, let me actually delete that, and that's a trick with comparing charts on TradingView, because it keeps it in its history, and you just want to do a new price scale. It slaps it right on the chart you're looking at. And short-term interest rate spreads are quite important for the FX market. Long ones as well, but short terms are quite important because they tell us what the central banks want to do. Central bank in New Zealand wants to hike rates. ECB won't be doing anything for a very, very long time. That really means EURNZD's fair value is way lower from what we can see here. I'm not talking 100 or 200 pips. This is a move that could be exceeding 500-600 pips. I'm quite interested to get short on this. Mind you, shorting EURNZD is incredibly excruciatingly painful because it chops about for not weeks but sometimes months, and then just all the big moves all at once. So keep that in mind in terms of long-term trading. You want to be shorting EURNZD, where the value for that is well underneath 165 in my opinion. The second one I like to have a look at, and that might be more imminent, is USDJPY. In terms of what we said happens to the yield curve, it's going up. USDJPY should be going up with it. It's kind of like a pace-to-pace strong correlation dynamic where you find the USDJPY will start climbing above these levels again as long as the yield curve stays alive and it starts sloping up again. See, this one we discussed earlier. So you want this to stay alive. So keep that on your charts, and you can put it on TradingView and you can view it throughout the day. It's quite important to the whole narrative because the market has been closely following the yield curve lately. That means any move higher or lower will be reflecting all the other trades as well. So this is 2 or 3 key trades I'm looking at throughout the summer. In terms of calendar, we have the CPI on Tuesday. That means you don't want to be doing any trading on Monday because it's going to be extremely choppy as we've seen in the past. We also have the 10-year bond auction in the United States, and usually get to see supply concessions, which should drive the yields a little bit higher, so I like to keep an eye on. So moving on to Tuesday, we have the CPI report. The CPI report itself creates a little bit of a wiggle, but the big moves comes always after London fix, which is 4 o'clock London time. Mind you, we are operating under British summer time right now, so it might be different from what you're used to. Back then it might be GMT, now it's BST. So 4 o'clock London time, we have the London fix, and you find that the big moves come after the fix, usually unlocking huge volatility after the CPI. So keep an eye on for that. I've had a couple of videos before in the past where I showed the examples from GBP/USD. We get outside moves more than 150 pips, closer to 200 pips in the following days after the CPI. We have our RBNZ statement. I have no idea what they will say. They're probably going to be hawkish. There's no new news. Same thing with Bank of Canada. You will expect some volatility, but the best moves should be probably fading loads of these moves because there's a lot of the communications already in the price, and I doubt they're going to tell us anything new. Interesting, what I'd like to see is probably Fed Chair telling us that the economy is chugging along well, and probably talk down the immediate tapering possibly. That could be a little bit dollar negative, quite positive for the yields. So keep an eye out for a good positive risk environment around Wednesday, and maybe show its face around Thursday. And last thing I'd like to talk about is we have a couple of Chinese data out as well. So we've got the GDP, and I think we have some production manufacturing somewhere. I thought I saw it. Quick look. Can't find it now, but it's 1 or 2 data points from China that are out. Now, given the last week they've cut rates, we're very likely that these data points are not going to be very strong. That could weigh on AUD, so keep an eye on for AUD to lose ground a little bit. Possibly against one of the stronger currencies next week. Ideally, probably EURNZD. It will make more sense for this to start climbing lower again, specifically because it's a yearly open. I don't feel like this is where it's valid. It should be lower, specifically when RBNZ wants to hike rates. Something to keep an eye on. So there's a lot of moving parts next week. I think we have 1 or 2 good trades throughout the rest of the summer we can keep our eyes on, and then move on to the following weeks. I hope you found this video useful. There's one last message I wanted to say, is that last week I think was very volatile week, was sometimes complex to trade. I heard a lot of traders didn't have a great week. Some traders had a really good week. What I hope for everybody to do is to just keep in mind that not every week is going to be great, not every trading week is going to be great. And I've been trading for near to 10 years, in my 9th year trading, and I can't really say it gets any better. Every day you just come and just do your best. The only rule you should have in trading is your risk management, and anything apart from that should really stay dynamic, where trading ranges can change, volatility can change, you can see a spike up and down and up again in the same day. So really prepared for everything when you trade. The only thing that's going to keep you long term in this game is your risk management, and I hope that you keep that in mind as well. That's all I wanted to say today. I wish you a very profitable week. Until next week. Bye.